Welcome to Carbon 13's podcast, Climate Takes. In today's episode, we're looking at the path to Series A for climate tech in a world where 80% of VC dollars is going to AI, something like 15% of seed companies are hitting Series A, and the gap between those who have taken just SEIS money versus institutional to Series A can be as high as a 7 multiple gap. So therefore, I'm delighted to be joined by Carmel Rafaeli, who has a deep understanding of the systemic issues of the path to Series A in climate, thanks to her role at The Table, which is solving the valley of death for female founders in climate in particular. So welcome to Climate Takes Series A. Thanks for joining us, Carmel.
Thank you for having me.
I think, first off, let's talk about The Table. Why you founded it, specifically to address this kind of journey from seed to Series A for climate tech.
Sure. So The Table is a community for co-investing in women-led climate ventures. We invite syndicates, funds, family offices, CVCs, debt allocators, actually any form of allocators to come and join us and share deals that they are actively participating from pre-seed actually all the way to B. That creates consistency and continuity. And they bring deals that they are participating in the round. There has to be a female founder holding substantial equity and solving anything that has a direct climate outcome. So we look at climate as a lens more than a sector. And it can be between technologies from hardware to AI, and it can be from industries of space to water, soil, food, fashion, energy, anything in between. And we do that because we think of climate as a macro problem that needs a variety of approaches, a variety of financial vehicles to come solve them, and a variety of solutions from incremental ones, real day-to-day solutions, new fabrics, new irrigation systems, new food, new infrastructure, to huge moonshots like carbon capture and so forth. So we really need to finance the whole spread of it. And we're building on top of that a catalytic capital vehicle that will be philanthropic capital that we will deploy alongside the investor tickets. This will be deployed as a forgivable revenue-based loan or recoverable grant, depending how you like your definitions, but it will come as non-dilutive, unrestricted capital to help create an influx of allocations into these women building in climate because they are so underfunded. So we know that about only 16% of climate financing is being met, but in climate tech in 2024, only 1% of capital went to all women teams and 7% to mixed teams. 92% of capital went to all male teams. And that's out of 26% of the rounds. So even per ticket, women are getting much less. That is a market failure. It's an allocation issue. And it's a climate issue because we need more approaches, more solutions coming through the pipeline. So that's what we built The Table for. And we came to this point, Julie and I, as angel investors, we were co-investing. We came together to invest in women building in climate. And we were super frustrated by seeing amazing women building amazing companies and just not getting the funding that they deserve. And this has been going on for way too long. So we were thinking, what kind of structure is missing in the ecosystem to change the market failure, to really change the size and the speed in which capital is flowing?
I remember having that initial conversation with Julie about The Table, where it's not just female founders are getting less of the dollars and fewer of the rounds. It also means that their runway is shorter. And when we're talking about the path from seed to Series A, what will kill the company is they will have that shortfall of a runway between one stage and the next, where for whatever reason, it's just taking them a few more months longer to make that next raise. And if they've been hobbled with a shorter runway than the tech and the idea and the TAM warrants, then it's a compounding damage, a vicious circle to female-founded businesses in climate, which therefore means that fewer climate tech startups overall are also being able to reach Series A.
Exactly. So what we're seeing is less capital is coming in. So on the one hand, they're over diluted.
Right. Oh, yeah.
So less capital comes in. Then they have less money to build with. So they're not building as big, as fast. They can't hit the same kind of targets as somebody that has more capital. Although women are 15% more capital efficient than men statistically. So they can do more, but it still doesn't get them as far. It also doesn't give them the 12, 18, 24 months that we want to see rounds last. So very quickly, instead of continue focusing on building, they're already thinking of this next raise. And we've shifted from pre-seed to seed to A to friends and family to pre-seed to pre-seed round to a seed round to a seed plus to a seed plus to a pre-A.
I've seen my first pre-A.
To an A to an A1 to an A2 to a pre-B. I mean, we're constantly fundraising. Now, there is a substantial lack of capital in the market in general. There is a lack of liquidity in the market in general. This is not only about women, but when we have a problem like this, women experience it worse. And so we need more of a runway to be able to build with inspiration, with conviction, to run faster, to get further. And that is systematically creating these valleys of death that become longer, wider, deeper. And women are always the first to experience it because they get so much less.
And we talk about conviction. Let's be specific about some of the successes that the table have had, right? So Carbon 13 has brought some of our startups to the table. The stats that you just gave, like 7% to teams with one female founder, we're at 63% of our 101 investments had at least one female founder at the time of investment. We're announcing a few more shortly, and that is at least half of the teams have a female founder. So already our statistics are quite different to the general space. Let's talk about some specifics, startups. Who's come through the table where your capital has been able to not match, but complement the investors' capital at the table?
So just a few things. Your statistic is really impressive. It is also important to say that many of the pre-seed accelerators have good statistics, not as good. That's part of a narrative that's important to notice and understand, is that it's not that women are not building in the industries. They're there in the accelerators, they're there in the incubators, they're there in the venture builders. They are just not getting the capital they need to make it further along. And so, yes, I think Carbon 13 builds with even more intentionality than many others. But across the board, we would see that in the earlier stages, there's a much wider representation for women, and they just die down faster. So that's one thing.
The pipeline's there.
Exactly. The pipeline is there. It's an access question. It's an intentionality question. And we are seeing it. So the table now is over 460 investors globally, from the US to Australia, writing tickets from 20K to tens of millions. We have officially shared our 201 deal the other day. We helped close 50 rounds. And among them are some of the Carbon 13 companies like Infosys. Manny AI was actually our first company ever shared on the platform. And then as we are growing and things are developing, I think we have maybe 5 or 6 of your companies running through the pipeline right now. Oralytica, Nendo.
Oralytica and Nendo, yes. Oralytica are doing hydrogel sensors to make visible whether or not food is going off or not, so it can replace sell-by dates. If food waste was a country, it would be the third largest emitter behind America and China. It's an example of a female founder and her male co-founder tackling one of the biggest problems that we have with genuinely innovative science. And Nendo, very exciting as well, micro irrigation using a ceramic technology. And again, micro irrigation, we're looking at TAMs worth billions and billions of dollars globally.
And solving plastic problem.
Yes.
At the same time.
Because it replaces the need for drip irrigation with plastics or metal or electronics as well, which is climate always intersects with something else, right?
Exactly.
Really does. Like the food waste intersects with health, for example.
Exactly.
So we're seeing that this model is making a difference. If we just do the maths on what you said, 200 deals, 50 closed, that's a 25% strike rate, which is already therefore beating the average already.
And it's over time, right? So initially we closed much less. It took us time to build up the pipeline. So now some companies we really helped close. Some companies kind of are halting their rounds for different reasons. And we have about 120 active deals.
Okay, right now.
So they're still running. Come join us.
So for any investors, when we talk about financing for climate, we're not just talking about VC dollars. And I think for any investor listening to this, it's an important thing that they're going to need to understand when they're evaluating a pre-seed venture, looking at their fundraising strategy. And I think that's also evolved over the last few years as the landscape's gotten more sophisticated. Could you please talk us through how has the capital stack for climate evolved, and what would we mean when we say blended finance?
Sure. So just before that, let's take for a second that climate is a really big kind of word. And in some places, we don't use it anymore. But climate, for us at least, engulfs a whole world of solutions that are about resilience, about supply chains, about sovereignty, about sustainability at the core from an operational perspective, not as a green word.
Cost of living.
Exactly. And efficiencies. And so we see that in the end, and I think we treat it very much as so at the table, most companies should have a climate lens embedded in what they're building, because if you're building something today that should last in 10, 15, 20, 25 years from now, we have to take into account people, planet, as well as profit. And so I think when we are looking at the climate financing challenge specifically, it's not about the AI solutions, maybe somewhat, but not as much. It's about what happens when we're building solutions that are infrastructure, that are hardware, that are materials, that take time to test, to scale, to educate the market, to reach commercial traction and price parity. And price parity is also an issue because we tend to say price parity to today, but as the years go by, externalities are affecting prices of everything. Water won't have the same price, food won't have the same price. So we have to also understand where exactly is price parity converging with commercial tractions. So there are a lot of different things at play, but we're in general thinking about things that aren't software-based exponential growth, what VC was traditionally doing. And from that perspective, we cannot have just VC money, because most of the VCs are thinking of it as 5 to 7 years. I want to see a turnaround. I want to see a return on my capital. I'm betting on one of 10, one of 50 that's going to give me my 100x, my 200x, 1000x if you're doing AI, and other stuff. And so in that sense, that's not the numbers that we're going to see for climate. We want to see continuous exponential growth, but the numbers will be different. And so we need different types of capital coming in. That means that we're learning more and more how are we working with government funding. It means that we have to learn more and more how are we working with corporates. How are we understanding their needs, getting their money for pilots, for trials, but also how are they as a route for M&As? How do we close the gap for debt financing, what kind of vehicles can come in for debt financing. There's an interesting world there that combines philanthropy, impact capital, and debt financing in this intersection of early days. So companies like organizations like Enduring Planet, Open Road, that are providing working capital loans at low, still at market rates, but lower market rates, and are kind of fed by at least somewhat philanthropic capital that are coming in. How are we closing data gaps to enable banks to be a player later, earlier on? And how are we educating investors at large of thinking about their return profile? So can I build my portfolio differently, gambling on less failure but lower returns per company? And what are my different partners in financing? And so how do I, as an investor, know to support the founders in the journey for grants, in the journey for loans, and other vehicles that are popping up along the way? And then what we're still missing, we're starting to see coming through as secondaries as a way to create liquidity in the market. And part of this is also educating LPs that return profiles look different, that liquidity timelines are different.
And therefore we can be armed with the strategies to move forwards, because nothing what you've described is an insurmountable barrier. That's the point. What we're saying is that we're understanding with more sophistication the challenges, and therefore we're able to try and build conviction with these different finances. And that's a change even from, say, 2020, that in this landscape that we're operating in. And it's something, I think, the way, when we're evaluating our startups pitching for us, even at pre-seed, is they're still going to have an understanding of what that financing path looks like, with a higher degree of sophistication than I would expect from a B2B SaaS company in a different sector, for example.
And also, do we have elements of first commercialization that can create some early revenues? Because our revenue timeline is different. And we should remember the angels that are a great way to get the capital with in the earlier days where VCs are having a harder time to build conviction.
We've spoken about 80% of VC dollars going to AI, which I'll come back to. But also, I think when we're talking about climate, we're talking about genuinely innovative tech, genuinely frontier scientific research that we're trying to commercialize. And when we're looking holistically on, say, a national level or European level or a continental level, wherever you might be based as an investor, we're all looking for, where can we find the growth? Where can we find a step forward technologically as well as commercially? And climate is such a hotbed for these exciting discoveries. We've just invested in a company called White Lotus Energies, and they believe that they have a path forwards to use photosynthesis in one step to create green methanol, a vital part of potentially sustainable aviation fuels, shipping fuels, etc. And if we look at the challenge for humanity, if we take climate away, any challenge is, where are we going to get cheap, clean energy from? And so a climate company might be able to do this in one step with photosynthesis, which would be a huge leap forward. And that's what we're talking about in climate.
Yes, and so I think the beauty of climate is that it's these moonshots that are going to be game changers in how we are producing, consuming energy, creating resilience, creating off-grid kind of independence. That's the one thing, and innovative things in the food and in the ag world. So that's the deep moonshots. But on the other hand, we are rebuilding our world in order for it to be sustainable, more balanced. And that is a lot of things that we did throughout the Industrial Revolution and need to redo them. And those are things that are much more incremental, that have much less development risk, and are much more about supply chains, execution, commercializations, network, corporates, and partnerships. And so I think we tend to always look at these kind of moonshots as our challenges, but it comes hand in hand. And that's kind of where we can play around with our portfolio structure. So we balance out our risk and returns, and we think about these solutions that also have to be financed. We will not drink the same water. We're not going to eat the same food because the soil is changing if we're not going to treat it. We won't be able to produce the same clothes that we're wearing today, and we don't want to. And so, how are we creating all of those things? How are we changing our plastics and our recycling and moving to a reuse mentality? Because we cannot continue to extract everything from the world over and over again. And so these are things that are much more kind of private equity-ish, actually. But we still need to finance them. They still have an innovation perspective, and they're also coming out of this kind of climate ecosystem. And so we need to think how we're raising all of them together. And I think that that's the opportunity of risk and return that we're overlooking.
I'm going to change tack slightly, and we're going to look at the founder journey. And at Carbon 13, we're not just an investor. We have a pre-program, we invest in the startups, and then actually we've now launched a new 12-month growth phase. And we're working with the startups that we've invested in over a 12-month period to work with them on that journey to raising that next follow-on round, right? We talk about ideally 12 to 18 months that they're able to secure that next round. And a lot of support, embedded entrepreneurs in residence, toolkits, workshops, industry mixers, demo days, and also flexibility actually was a core learning from the previous cohorts, the feedback that we were getting. The startups that we invest in that are ranging from software to deep tech have very different timelines for the help they need in that 12 months. They may not need, for example, the hiring and recruitment and culture workshops right at the beginning if they're one of the deep tech and they're just not hiring at this point, for example. In that journey from either pre-seed to seed or seed to Series A, I won't say what mistakes, I would say what are best practices that founders need to be looking at to increase their chances at raising the follow-on round?
I think mainly it's traction.
Okay.
So unfortunately, that needle is constantly moving further and further away. I've been having conversations with some of the other accelerators that we work with, and they're like, we don't even know what to tell our founders. We used to say, you need to be reaching TRL 5, 6, and you need to show some product market fit. All of a sudden, investors want to see $1 million in ARR before you even go raise your pre-seed. There is AI is creating this misalignment of what we're looking for. But I think at the core, we constantly need to be building for practical solutions. And so, on the one hand, if you're really deep tech, you want to be moving along the TRLs, but you want to also show that you understand the market. So it doesn't have to be contracts, but it has to show the engagement that you have with the market. And as you're shifting away from the deep tech into the productization and software, you have to start showing sales, real traction, real ability, because you can have a great product, but if you don't know how to sell it, how to market it, then it won't help either. So if you're doing this new kind of photosynthesis into methane, so how are you talking to the market? Where are you validating it? How are you validating it? Where are you thinking of the big scale operations commercialization of it?
The regulation of
it, especially for energy. But then on the other hand, when you're doing irrigation systems, right? Who are the farmers that are going to buy it? What scale? What are their price points? What are you replacing? How are you servicing? How are you continuously growing? And it is a really big challenge. But from pre-seed to A, that has to mature really quickly, month on month.
Right. I think about Cocoon Carbon is one of ours. They just did a $15 million Series A. Their beachhead is actually America, right? And I think they've done that work of understanding. So they're decarbonizing steel and cement. So they need to have their processor at the steel plant. And their customers, the managers that they work with, won't know they're a climate company. It's just good business sense. And that's why, even though they're a commodities business, great BCs like 2150 have invested in Cocoon Carbon. So that would validate your point for sure. And I would agree. I think at Carbon 13, we've seen the bar raise and raise and raise for the traction, particularly for the software startups, particularly. But this is competition, right? And I think this is my call to action in 2026. We are competing. Mm-hmm. An idea cannot be a good idea in isolation. Is it better than? Can it outcompete? And that's always my call to arms for our founders.
Yeah, and I would say that that's where pricing comes into play and efficiencies come into play. And the closer you can get to price parity sooner, the better it is. And it means that we also need to step away from regulation in most industries. So there are industries that are systematically regulated, especially across the UK and Europe. And if that's your playing ground, then that's fine. And so we also kind of say regulation can't be priced into it. In some places, it's already priced, and you can lean into that. But we have to also understand who's your market, where can you lean into it, and where you can't.
Yeah, you're saying that a startup can't bank on a regulation driving behavior alone.
Exactly.
Because the regulation can change, be repealed, et cetera, et cetera. That was raised at a roundtable I was at last week, which was to do with nature financing, but was looking at cement and water and something else. In the water industry, by the way, some of the regulations that one of the founders was talking about, in Canada, to get it approved is 18 months. In the UK and the EU, it's 5 to 6 years. So I actually saw in the King's speech, there's regulations for growth, which to a lot of people might seem like an oxymoron, but they are talking about the creation of sandboxes so we can fast forward the regulatory approval for the genuine innovations and step changes.
That's when regulations are a hurdle, but sometimes regulations are in your favor when they require recycling and EPR and other elements that have to be priced into operations today and open a door for you for efficiencies and scale.
Exactly, particularly in recycling. I can't remember the stat, but it's something like 2035. It's something like 100% of waste recycling. One of our startups, TerraSort, is gunning for that. Robotics plus AI. There's been a few players in this space. We've been able to use our experience to have conviction as to why they will outcompete. And they think their capex, for example, can be 10 times cheaper.
Yeah.
So that's how they were convincing ourselves. Okay, we're coming to near the end of the podcast. I have a couple of final things to ask you. 90% of angel investors are male. So I have two questions. What would you say to a male investor who wants to build a better network or pipeline of female-led deals?
So any investor, angel or otherwise, I think having a more diverse pipeline has to do with intentionality. What rooms do you step in? How do you present yourself? Who do you end up actually investing in? So part of it is putting yourself out there, calling for, especially if you're an angel, calling for these these founders to come to you. But as funds, it's about what's your forward facing, what's your website, what's your LinkedIn, how much do you come to events to talk about diversity? So it's very much about intentionality and how we're doing that that work. And I think it's important to remember, diverse teams outperform. Women utilize capital better. It is a good, strong, financially beneficial business decision to invest in women. This is not about doing us a favor. It's about us doing you a favor.
You're right. It's the intentionality and understanding that word of mouth referrals may skew in one direction, so you need to have that intentionality to step out of that loop. But then also vice versa. If you're talking to a woman, what would you say to her to consider becoming an angel investor?
So I think First of all, it's always hard to tell people to become angel investors because it's risky capital and you kind of need to be able to, or you need to be able to write off every check that you write. And there is no guarantees about anything. What I say to women that are thinking about doing angel investing is that there is a lot of power in being an allocator, and you can do it with really, really small tickets. So I am I do a lot of angel tickets, but as you know, they are tiny, and I do 2 meetings, 2 weeks, 2K. I don't take a lot of time from the founders, but I also give a very small amount. But there is value in that. It gives me exposure, it helps me build knowledge. And at the same time, I am in a position to be part of the support network for these founders. And hopefully, I'll also have an upside. But there is such a need from founders, and if you're doing LP tickets for GPs, to have a women's voice in the room on the cap table as a support system. And so if you do have the capital and you can risk it, I think it is one of the most amazing worlds to open a door into. You get to see incredible people building unbelievable solutions that are inspirations, and you get to be a part of their journey. And so it's a pay to play kind of a thing, but and it theoretically has a potential for an upside. But more than anything, it's a way to support amazing people doing incredible work.
100%. It's almost like if you're considering being a mentor, or if you already are a mentor and you have that capital that you can put at risk, you should explore it. And Female Angels, very friendly bunch, very welcoming. Everybody's more than happy to educate, share learnings. It's a very collaborative community. It's really just a community that you find and participate in, really.
Yeah, people that are taking all kinds of AI courses and programs and want to be smart with their money. So our angel communities, I'm part of Alma, I'm part of C. There's in Europe, you have Evangelista, and there's also communities that aren't necessarily women focused, but these are places for education. And as you participate, and if you are a sophisticated investor and you're eligible to do these kind of tickets, because there are criteria for that, it is a way for you to open new worlds of knowledge and social for yourself. So I don't think people come for the social, but it is a really nice benefit.
It's a plus. No, well, I had a great social time last night at such an event, so I can vouch for that. Okay, and then final question: what is your climate hot take?
Oh, probably not what you would think.
Good.
But my climate hot take is that we need more forms of capital in our ecosystem quickly, and so that's why we're raising our philanthropic capital. We need to see more family offices playing a role in financing it, financing climate in general, and we need to just think of how we're collaborating across the capital stack.
What's the one thing that you would say to a family office then?
That long term, it only makes sense to invest in climate, whether it's for moonshots and and climate funds, by the way, but whether it's moonshots or whether it's kind of incremental stuff, this is the opportunity to change the way we are consuming, building, and living on this planet. And any company should have a climate lens. And so it is a world of new opportunities, a bit like the Industrial Revolution.
Okay, 100%, Carmel. Thank you very much for joining us. Thank you, Carmel, for those wonderful insights. I'll be thinking about those for days to come. I think what we can take away from this episode is that the capital stack for climate is evolving and maturing. That how we look at the female progression from pre-seed to seed to Series A, it's not a pipeline problem. It's a systemic barrier problem, which are solvable. And that we encourage more and more people to come and participate in this ecosystem. Thank you very much for listening. This is Climate Takes Series A.
Thank you for having me.